Welcome to the Opening Bell Report.
If you've been watching the markets today, well, specifically the crypto mining sector, you might have thought your screen was broken.
Yeah. Something is definitely off.
We are looking at Monday, February 9th, 2026. And, usually these stocks move in a pack. Bitcoin goes up, the miners go up.
It's been a simple algorithm for years.
But today, that rule book is it's out the window. We're looking at Terawulf, ticker WULF. The stock is sitting at $16.65.
Which is a massive jump. What is that, over 16%?
16.5% in a single day. And here's the kicker, Bitcoin. It's basically flat.
It's choppy. It's not doing anything to justify that kind of move. It's a complete decoupling.
And what's wild is that $16.65, that's a fresh 52-week high. This isn't some dead cat bounce.
No, this is a breakout that is totally ignoring what Bitcoin is doing.
Exactly. And that is why we are doing this deep dive. We have to answer the question, is this just hype? A company slapping AI on a slide deck.
Or has the business fundamentally changed under the hood? It's a billion-dollar question.
Right. So for this, we're unpacking a really comprehensive analysis report. It's titled The AI Infrastructure Pivot. It's basically hot off the press, covering Q3 financials and what analysts are thinking.
And we really need to start with that word, pivot. Because in the business world, pivot can sometimes mean,
desperation.
Exactly. It can mean our first idea failed. But the report suggests this is different. It's more of an evolution. They're calling Terawulf a vertically integrated digital infrastructure company.
Okay, let's stop there. That is a mouthful of corporate jargon. What does that actually mean?
It means they're not just renting anymore. In the old model, miners just own the machines, the ASICs.
And they'd plug them in wherever they could find cheap power.
Precisely. Vertically integrated means Terawulf owns the land, the building, and most importantly, they own the power connection. They control the electron from the grid all the way to the chip.
So they're the landlords, not the tenants.
They are the landlords.
Yeah.
And that's everything, because of who wants to move in now.
Which brings us to the catalyst. This huge joint venture with FluidStack and Google, the 150 megawatt deal.
Mm-hmm.
We hear about AI deals all the time. Why is this specific one driving the stock up 16%?
Because it's the proof of concept. You have to understand, mining Bitcoin is, engineering-wise, it's pretty forgiving.
It's what they call interruptible load.
Right,
Okay.
exactly. If power prices spike, you just turn the miners off.
Yeah.
No big deal, nothing breaks. The Bitcoin blockchain doesn't care if you unplug for an hour.
But AI is a totally different beast.
A completely different beast. You can't just turn off a data center that's training a large language model. These clients demand 5 nines of uptime, 99.999%.
So the infrastructure requirements are just worlds apart.
Worlds apart, you need backup generators, advanced cooling. I mean, NVIDIA's new chips often need liquid cooling. It's not just fans anymore.
So when Terawulf signed this deal with Google for their Lake Mariner facility, they weren't just signing a piece of paper.
No. They were proving they could build Google-grade facilities. Google does not sign a 150 megawatt deal unless your engineering is absolutely flawless.
And that signal to the market is what explains the decoupling we mentioned.
Yes. The stock is up, 215% in 6 months while Bitcoin is just chopping around? The market gets it.
I want to use an analogy here. Tell me if this makes sense. It feels like Terawulf has been a landlord for a rowdy rock band.
I like that. Go on.
The rock band, that's crypto mining. They might pay huge rent one month if they have a hit record, and Bitcoin soars.
But the next month, they're broke, they're trashing the place, and you have no idea if you're getting paid.
Exactly. It's pure volatility. Feast or famine.
Painfully accurate.
But now, Terawulf is kicking the rock band out. And they're signing a lease with a library. Or a bank. That's the AI client.
Yes.
The library isn't going to pay $1 million one month and zero the next. They sign a 10-year lease. The rent is fixed, it's boring, it shows up every month.
And investors love boring, predictable cash flow. That is exactly what's happening. The market sees them swapping volatile crypto revenue for stable, long-term AI contracts.
So the stock goes up even when Bitcoin doesn't because the library pays rent no matter what.
Exactly. But let me play devil's advocate for a second.
Please do.
Because if you just read the headlines, everything sounds perfect. But when you actually open up the Q3 2025 financial report, it's not all sunshine.
I was hoping you'd bring this up. I'm looking right now. Revenue is explosive. $50.6 million, up 87%. Great.
Looks amazing on the surface.
But then I look at the bottom line, net income. They lost money. ETS is negative $1.13.
Right.
So a skeptic looks at this and says, wait a minute, all-time high stock price, but the company is losing money. What gives?
And it's a valid concern. But this is what the report calls their Amazon moment.
The Amazon moment? That's a bold comparison.
It is, but think about early Amazon. For years, Bezos was criticized for not making a profit. Why?
Because every dollar they made went right back into building warehouses and servers.
Exactly. They were intentionally burning cash to build a moat, trading short-term profit for long-term dominance. The report argues Terawulf is doing the exact same thing.
So they're unprofitable on paper because they're pouring all their capital into building these data centers.
Yes, you have to look at the cash flow statement. Their operating cash flow is turning positive. The core business is making money.
But their free cash flow is negative, about, what, $35 million a quarter?
Correct. And that's because they're spending that $35 million on concrete, cooling systems, transformers. In this industry, that cash burn is actually a good thing.
It's a sign of growth.
It's a sign they're racing to meet demand. But spending is risky. We've seen miners go bankrupt from overexpansion.
That's the shadow that hangs over the whole sector. What if they run out of cash?
This is where their balance sheet really separates them from the pack. They have a war chest.
The report says,
Oh,
wow, $712.8 million in cash on hand.
that is a staggering amount of liquidity. It basically negates the bankruptcy risk. They can fund this entire expansion without diluting shareholders or taking on bad debt.
Okay, so they have the plan, the partner in Google, and the cash. Now let's talk price. Is the stock expensive?
Well, expensive is relative.
Yeah.
And this is where the competitor comparison is so interesting.
Right. The report breaks down the multiples. Terawulf is trading at about 13.7 times sales. Then you look at a big competitor like Riot Platforms. They're at only 6.8 times sales.
Not even close.
So Terawulf is literally twice as expensive. Why is Wall Street paying 100% premium for WLF?
It's that philosophical split. Riot is a Bitcoin maxi play. Their whole strategy is mine and hold Bitcoin. They are betting it all on the price of Bitcoin going to the moon.
So buying Riot is just a leveraged bet on Bitcoin.
Exactly. It's high risk, high reward.
Yeah.
Terawulf is building a utility. The market pays a higher multiple for certainty. Investors are saying, I'll pay double for the safety of that 10-year Google contract.
It's the difference between buying a lottery ticket and buying a bond.
Or, to use your analogy again, it's investing in the building, not the rock band's tour. The building has intrinsic value.
The report also brings up CleanSpark, CLSK. How do they fit in?
CleanSpark is the efficient operator. They're actually profitable. They run a tight ship. Great balance sheet.
But the stock performance tells the story. WLFF is up over 100% this year. CleanSpark is flat.
Why? Because CleanSpark is still seen as a Bitcoin miner. Terawulf is being seen as an AI infrastructure play. And right now, AI infrastructure is the golden goose. Capital is flowing there.
It just shows the power of narrative in the market.
It really does. And the analysts are arguing that while 13x sales is high for a miner, it's actually cheap for a data center company.
Oh, that's an interesting frame. So compared to the real AI giant.
Exactly. Compared to an Equinix or CoreWeave, WLF looks like a value play. It's a cheaper entry point into the whole AI infrastructure boom.
Okay, let's shift to the technicals, the chart. The report mentions a classic pattern here, the cup and handle.
It is a classic. And even if you don't believe in chart patterns, you have to understand the psychology behind them.
So break it down. What does that pattern actually mean?
Okay, so the stock hits a high, let's say $15, then it sells off. That forms the left side of the cup.
And the people who bought at the top are now losing money. They're nervous.
They're very nervous. Then the stock slowly grinds all the way back up to $15. When it gets there, those nervous people sell. They say, thank God I'm back to break even, I'm out.
And that selling pressure creates the little dip, the handle.
Exactly. But if that dip is shallow, it means all those sellers were absorbed by new buyers. And once they're gone, there's nobody left to sell. The ceiling is gone.
And that's what happened when WULF broke through $15. The report calls the price now $16.65, blue sky discovery mode.
It's a great term. It just means everyone who currently owns the stock is in profit. There are no bag holders waiting to sell. It's the path of least resistance.
So based purely on that momentum, where are the targets?
The technical targets are in the 20 to 24 $24 range by mid-year.
That's another 20 to 40% from here.
It is. And the fundamentals back it up. With revenue projected to ramp up as that new capacity comes online, it's a powerful combination.
All right, we've covered the bull case, but I have to be the skeptic. What goes wrong? What's the biggest risk here?
Execution risk. Plain and simple.
It's one thing to sign the paper.
It's a completely different thing to actually build a 150 megawatt high-performance computing facility on time and on budget.
And the bottlenecks are what? Supply chain?
Supply chain. Specifically, high-voltage transformers. You can't just go buy those at Home Depot. The lead times can be 18, even 24 months. If they can't get the gear, they can't turn on the power.
And if they can't turn on the power, Google doesn't pay.
Worse, Google could cancel. Hyperscalers are ruthless. If you miss deadlines, they move on. That premium valuation, that 13x multiple, is priced for perfection. Any stumble, and the stock could correct, and correct violently.
So they're priced like they've already won the game, but they still have to go out and play it.
That's a perfect way to put it. They've graduated to the varsity league. Now they have to perform at a varsity level.
Before we wrap, there's one last thought from this report that really struck me. We've spent years hearing how crypto mining is a waste of energy, bad for the grid.
Right, that's been the dominant narrative.
But now, the only companies that have these massive power connections ready to go, the only ones who can actually feed these incredibly hungry AI models right now, are the crypto miners.
It's the ultimate irony, isn't it?
It really is. They spent years building all this infrastructure, and now that infrastructure might be the only thing that can keep the AI revolution moving.
You could argue that the future of AI is actually dependent on the physical backbone built by crypto.
And it makes me wonder, in 5 years, will we even call companies like Terawulf miners anymore?
I don't think we will. I think we'll look back at the mining phase as just the way they bootstrapped the business. It paid for the infrastructure. The end game was always to become a utility for compute. We'll just call them the power plants of the internet.
A fascinating evolution. Well, if you're holding WULF, enjoy the blue sky, but keep a close eye on those construction updates.
Don't forget to like, share, and subscribe for more.